कैसे किया?
वही रहते हैं वैसे मार रहा था वैसे नहीं स्ट्रेटेजी की
जब मेरा भी है कर दिया मेरा भी मेहनत क्या लगी
Hi everyone, guys. Good morning.
Good morning, sir.
Am I audible properly?
Yes, sir.
Yes, sir.
All right. Let's go ahead, guys. Any doubt in whatever we have discussed so far? Or shall we go ahead? Okay, let's go ahead. Our next topic is swaps contracts. So again, we are continuing with derivatives, but we are looking at the fourth derivative. Okay, we looked at forwards, futures, and options. Now we are looking at swaps contracts. These are also derivative contracts. Any idea about swaps, guys? Have you heard this term?
Yes, sir.
Guys, any one of you pursuing CFA?
Yes, sir. Sir, is I'm audible, sir?
Okay, maybe in your BCom, MCom, you might have heard this. Swaps.
Sir, is I'm audible?
Exchange of financial instruments between the parties.
Exchange of financial instruments between the parties is more or less the definition of trade. Anybody else?
Sir, is I'm audible?
Okay. No worries. See, guys, we are going to talk everything about it today. So you will have a good idea by the end of the class. Okay?
Is I'm audible, sir?
Yeah, Rajwal, you're audible.
Sir, I think swap is the financial instrument exchanges of cash flow between one or two more parties, or liability is there from them.
See, guys, swaps contracts are again derivative contracts. Do you remember forward contracts? Yeah. What were the features of forward contracts? Can anybody tell me? What were the features of forward contracts? Quickly, guys, they were OTC traded, right?
Corporates or large institutions.
Sorry?
The party.
Your voice is breaking.
Sir, the participants were instead large institutions or corporates, not individuals.
Very good point. Very good point.
And so they are illiquid in nature.
Negotiated contract between the two parties.
They were illiquid in nature. Very good. These were negotiated.
उसको hedging
Yeah, they can be used for speculating, arbitrage, or hedging. That's it. What else?
Counterparties at default risk.
Counterparty or default risk. Yeah, because there is no clearinghouse or no exchange, so we say there is a counterparty or default risk. Right now, guys, all these features which you have mentioned for forward contracts, all these features apply to swaps contracts as well. Okay, where are they different, guys? What happens in forward contracts? There is just one settlement date, but in swaps contracts there are multiple settlement dates. Okay, or you can say more than one settlement date. Okay, so if you are clear with forward contracts, which are quite straightforward, frankly, so if you are clear with them, swaps is not going to be a big deal. Are we clear with this difference, guys?
Yes, sir.
Okay. And just like forward contract can be based on any underlying asset such as equity, fixed income instrument, currency, interest rate. Similarly, swap contracts will have an underlying asset based on which they will derive their value. Okay. So in our curriculum, guys, which tab we are going to talk about 4 swaps contracts. One is the interest rate swap. Let's make a guess, guys. What do you think will be the underlying asset in interest rate swaps? What will be the
Interest rate.
Sir, the collateral? Interest rates. Okay. What do you think will be the underlying asset in case of equity swap?
Equity shares.
Equity
Shares.
Equity or index. Okay. We'll talk more about it. In forex swaps,
Currency.
Foreign
currency.
currency exchange rates. Okay. In credit default swaps, have you heard about this, guys?
The liability or the credit default of
Anybody heard about CDS? Any idea about 2008 financial crisis?
Yes, sir. I have watched the movie, so I've heard this term.
Awesome, awesome. Which movie?
The Big Short.
All right, great. Guys, everybody should watch these movies, okay? I mean, some movies are good, so we should definitely watch them, specifically related to investment banking. So whenever you are free on a Saturday or a Sunday, maybe you can take some couple of hours and you can go for that movie. Okay, guys, CDS were the main culprits for 2008 financial crisis. So when we are discussing CDS, just remind me, I'll talk about 2008 financial crisis also. Okay. All right. So what is the underlying asset in case of credit default swaps? Credit quality of the borrower. Don't worry about it right now. We are going to talk about all the 4 swap contracts one by one. So you will become clear on exactly how it works. But just note it down till here. If you have any doubt, let me know.
Sir, sir,
Yes.
sir, in option contract, little bit of swaps and convertibles is also traded.
In option contracts,
Yes,
see
sir.
options are
Sir,
options.
I read it somewhere, sir.
Buddy, from where do you read all this stuff?
Sir, I read it in the school.
No, don't confuse yourself. Option contracts are different contracts. Swap contracts are different contracts. Okay, there are swaptions also, which are different. Okay,
Okay, sir.
so don't need to complicate things. Okay, is it noted, guys? Can we go ahead?
Sir, what does multiple settlement date means?
We'll come to that. Okay, I'll give you an example. When we are discussing these contracts now, then you will automatically understand what do we mean by multiple settlements. Okay, so guys, let's start with our first one, that is interest rates. Now within this, there are two types. One is your plain vanilla, and the other one is basis swap. Okay, what happens in plain vanilla is the cash flows are exchanged on the basis of a fixed interest rate versus a floating interest rate. Okay, we'll discuss the example. It will become clear to you, but for now, just note it down. In plain vanilla, the cash flows between the two parties are exchanged based on a fixed interest rate versus a floating interest rate. Whereas in basis swap, the cash flows between the two parties are exchanged on the basis of floating versus floating interest rates. Okay, so guys, let's talk about plain vanilla interest rate swaps. Okay, now let's look at it in depth, and we'll automatically get to understand all these things. Whatever we have said so far, it will become clear now. So let's look at it in detail, guys. What does plain vanilla interest rate swaps mean? See, in forward contracts, there were two parties, right? Similarly, in swaps, there'll be two parties. Okay, let's say BlackRock versus JP Morgan. Okay, so there are two parties, and the two parties will have different views. Okay, for example, in a forward trade, what happens? Somebody thinks the price of wheat or price of crude oil will go up. Other party thinks it will go down. Okay, similarly here, two parties will come together who have opposite views. So one party will take one position and the other party will take the opposite position. Okay, similarly, guys, here one party thinks that the interest rates in the market are going to go up. Okay, so I'm just writing it down so that you can remember. One party expects interest rates to go up. Okay, the second party, the other party, or you can say counterparty, expects interest rates to go down. Now, when such a scenario is there, these two parties can enter into a plain vanilla interest rate swap. Okay. Now, how does it work is one party, guys, let me give them names so that you can relate to it. Okay, so there is, let's say, ABC, and so this can be any financial institute. Okay, I mean, it can be a hedge fund, it can be a company, it can be an investment bank, it can be anybody. Okay, so let's say ABC expects interest rates to go up and XYZ expects interest rates to go down. Okay, now ABC and XYZ can enter into a plain vanilla interest rate swap. Okay, let me call it IRS just to save some time. I'll call it interest rate swap. Now, what will happen in this contract is ABC will make payments based on a fixed interest rate. ABC will make payments based on a fixed interest rates to XYZ. Okay. And in turn, receive payments from XYZ based on a floating exchange rate, floating interest rate. Sorry, guys, I always. Okay. So what will happen? There'll be a notional amount. The two parties will decide. Okay, it's a negotiated contract between the two parties. So two parties will decide that, okay, we will have a notional amount of, let's say, $100 million. Okay, and there'll be a fixed swap rate. That is what we call as fixed interest rate. Okay, nothing complicated, guys. The fixed interest rate is also known as swap rate. Okay. Let's say it is 4%. And there'll be a floating rate, which is, let's say, LIBOR plus 1%. So whatever is the LIBOR, we'll add 1% to it, and based on that, the payment would be made. Okay. So what is happening is, and let's say the tenure of the swap is 2 years. And it is quarterly payments or quarterly settlements. Okay. So what will happen, guys? Let's say these two parties enter into the contract on Jan 1st, 2020. So what will happen? There'll be 4 settlements. This is what we mean by multiple settlements. When will these settlements?
Sir?
Yeah.
Sir, full form of LIBOR.
I'll come to that, okay? So there'll be 4 settlements. One will be, guys, can you make a guess? Sorry, let's make it semi-annual semi-annual. Okay. Yeah. Now there'll be 4 settlements. Can you tell me when the settlements would happen?
1st July.
Every 6 months.
Sorry?
On 1st July.
On 1st July, okay. 2020. When will the next settlement happen?
1st Jan 2021.
Very good. Third one?
1st July 2021.
Good. And fourth?
1st Jan 2022.
Okay. So this is what we mean by 4 settlements. It can be any number of settlements based on the tenure and how frequently you want to settle. Okay. We also call them reset dates. We also call them reset dates. Okay. So what is happening here is ABC Yeah. Can anybody tell me what is the payment ABC is going to make to XYZ on every settlement date? Guys, let's make a guess, okay?
At 4% to XYZ.
4% of
4% of
100
100
million.
million. 100 million.
100 million. Excellent, guys. Very good. So you are awake. That's good. So that means how much? 4 million. So XYZ is going to pay 4 million to, sorry, ABC is going to pay 4 million to XYZ when?
1st July.
On every settlement date, okay? So it's just not a one settlement like a forward contract, it is multiple settlements. So every 6 months, they are going to make a payment of 4 million to XYZ. And what is XYZ going to do? XYZ is going to make a payment of LIBOR plus 1% in 200 million, this much payment to ABC. Now, what is LIBOR? LIBOR is, guys, London Interbank Offered Rate. Okay. In this case, we'll call LIBOR as our benchmark rate. What does this mean, LIBOR? It means that, see, in London, there'll be multiple banks. Yeah. You remember we discussed about interbank lending?
Yes.
Yeah. I think we might have discussed about LIBOR there or my.
No, sir, LIBOR not.
Okay. See what happens? There'll be multiple banks inside London and they would exchange funds between themselves for a short period of time. Okay. At different rates, right? So what do? You see on average, what is the rate which banks are charging to each other for, let's say, 6 months period. Okay. So what I mean is one bank would be charging a particular rate for 6 months loan. Yeah. The other bank might be charging a slightly different rate. The third bank might be charging a slightly different rate. So what do? In very simple terms, guys, it's not exactly this much simple, but for your understanding, you can say that you take an average for that.
Sir?
Yeah.
But the LIBOR average would be given by the Central Bank of London.
LIBOR average could be
Given by the Central Bank of London. So that
given.
Same LIBOR rate would be exchanged between the banks.
No. See, the banks are free to charge their rates, but London Central Bank of London can figure out what is the LIBOR rate in general. Okay, based on at what rates the banks are swapping their funds, exchanging their funds. So you simply can take an average of that, and that would be considered as LIBOR. Okay, so let's say the banks are exchanging the funds between themselves for 6 months at a rate of 3% annualized rate. Okay, it will be annualized rate. So let's say they are charging at 3% for 6 months exchange of funds. Now, 1 month later, this rate can be different. The next day itself, this rate can be different. So this rate would keep on changing, right? Every day, the exchange of funds is happening at a slightly different rate. So we can say that LIBOR will keep on changing based on the demand and supply of money between the banks. Similarly, guys, you also have MIBOR. What is it? Mumbai Interbank Offered Rate. Okay, So in most of the markets, you will see that there is a particular rate which is happening. In US markets also, there is a rate at which the banks are exchanging the funds. Okay, so there can be a slight difference in terms of different banks charging different rates, and then you find out what is the average rate to find out what is, to get an idea about LIBOR or MIBOR. Now, every day, based on the demand and supply of funds, this rate can change slightly. So that's why we call it a floating rate. Are we clear with this, guys? Yes or no?
Yes, sir.
So can you repeat the MIBOR part again?
You understood LIBOR?
Yeah.
Same thing, what is happening in London market, the rate at which the banks are transferring the funds within London market, based on that we have LIBOR. Similarly, the banks in Mumbai would be transferring the funds to each other at different rates. Based on that, you can calculate the MIBOR. That will be Mumbai interbank offered rate. Okay, exactly the same as LIBOR.
Okay, sir.
Sir,
Yeah.
the notional amount would be settled by both the parties, right? Before the contract.
Notional amount would be?
Being settled by both the parties, on which rate would be, on which amount would be.
No, we are not exchanging the notional amount.
No, sir, I mean the notional amount would be as per the.
Yeah. What is the notional amount? The two parties will decide for themselves. Okay.
Okay.
I mean, there'll be one notional amount, but it would be, it would be negotiated. What is the exact notional amount? What should be the exact notional amount for the swap contract? This would be decided by the two parties themselves. Okay, it's not a standard figure. Guys, these are negotiated contracts. So everything, whatever I have mentioned, would be negotiated between the two parties. Two parties will decide for themselves what do they want to keep as LIBOR rate, what do they want to keep as fixed rate, what do they want to keep as everything. Okay. But are we clear with LIBOR, guys? See, the floating rate can be based on any benchmark. I have taken a reference of LIBOR, but it can be based on MIBOR. It can be based on Fed fund rates at which the US banks are exchanging funds. It can be based on some other interest rate as well. Okay, it might be based on CRR, anything. So what we want is we want a rate which changes. It should be floating rate. That could be used as a benchmark. I have just taken an example of LIBOR. It could be anything with changes. Guys, note. Yeah.
Sir, in this contract, so there is no buying or selling of the underlier, but just the two parties are taking the advantage of increase or decrease in the interest rate.
Absolutely. Guys, whenever everyone is clear with all this, we can go ahead. Okay, I'm waiting for your confirmation.
Sir,
Huh?
when the settlement dates will be completed, then the notional amount would be received by the companies or not?
No. See, no, neither at the start, nor during the settlement dates, nor during the final settlement, never the notional amount would be paid or received by any party. It is just a notional amount we have kept in the contract to make calculations on every settlement date. We are never exchanging the notional amount.
So they will only receive interest.
They will receive or pay the payments based on
Yes.
the interest rate.
Okay.
See, if we go back, what was the expectation of ABC?
Interest rates to go up.
Okay, now you tell me, if this is the contract, if interest rates go up, will ABC be in profit or not? Can you relate this thing with this thing?
Yes, sir.
Is there
Yes.
Yes, sir.
and what is happening in the contract?
Sir, the LIBOR will increase.
Who will gain if interest rates go up here?
ABC.
ABC.
And who will gain if interest rates go down?
XYZ.
XYZ.
See, this is the contract, basically, okay? Parties are trying to make profits based on their expectations, or the two parties might be trying to hedge their risk using this swap contract. Okay, so guys, what we understand is that if we expect the share price to go up, we can make profits. But there are so many instruments in the market which you can use and play based on your expectation on anything. Okay, for example, did you ever thought about that can somebody make profits based on their expectation on interest rates? So what you are seeing in front of you is a contract from where you can make profits even on your expectations on interest rates, right? So don't restrict yourself to just the equities part. You can take a call on anything: crude oil, wheat, interest rates, atta, chana, currency exchange rate, anything, guys. There are instruments to take a position based on that asset. So That's the beauty of derivatives. You can say that they allow you to take exposure without actually buying or selling the asset, but they allow you to make profits or hedge your risk based on most of the things.
Sir,
Yeah.
sir, here the payment made by ABC is fixed, right? Because he's making payment on the basis of fixed rate. Fixed rate.
Absolutely.
So only the floating interest rate will change.
Absolutely.
Okay.
Sir, it would be more of speculation than hedging.
No, it can be hedging also. Okay. But yeah, more of speculation than hedging, that I agree. Guys, is it clear? Can we go ahead?
Yes, sir.
Yes, sir.
There is no confidence in your yes. Are you really clear or not? Guys, I'll repeat everything. Don't worry. You have to be clear, okay? Let me know.
Clear, sir.
Yes or no, everyone?
Yes, sir.
Yes, sir.
Okay. Okay. So please note couple of points. I hope you are clear with this, right? Okay. Let's look at an example, guys, to make it more clear. Okay. Please read this. Okay, guys, is the question clear to you?
Yes.
Yes, sir.
Yes, sir.
Okay, so two parties, company A.
Sir,
Yeah.
I'm not clear with the last line. Company B agrees to make payments based on 90-day LIBOR plus a margin.
Yeah, I'll tell
90-day
you.
based on.
Yeah. So basically, uh, when are the settlements happening? Every quarter, right?
Yes, sir.
Every 90 days? Yeah.
Yes, sir.
Yes, sir.
So which reference rate will use? See, guys, okay, let me try to explain this. Let's imagine London. Okay, the banks are exchanging funds between themselves, right? Yeah. So they will be exchanging for 1 month, let's say. They might be exchanging for 3 months. They might be exchanging for 6 months, right? Just some examples, yeah. The average rate at which they are exchanging the funds for 1 month, that will be known as 30-day LIBOR. The average rate for which they are exchanging the funds for 90 days would be known as 90 days LIBOR. The average rate at which they are exchanging the funds for 6 months, it would be known as 180-day LIBOR. Are we clear?
Yes, sir. Yes, sir.
Okay. So what we are talking about right now, 90-day LIBOR. Okay. All right. So guys, what is happening here is there is a company A. Can anybody tell me what is the expectation of company A?
That interest rate will go up.
Because
Going off.
Yeah. Okay. That should be the expectation of company A, because they are saying we will pay what? What is the
interest
slab?
rate of
1 lakh.
6% fixed interest.
Yeah. So we are going to pay 6% of this much, $100,000. So that would become $6,000 to company B. Are we clear?
Yes, sir.
And what is company A going to receive?
LIBOR plus 1% margin.
1.5% plus 1%.
Specifically 90-day LIBOR plus 1% margin, this much into 100,000, right? So this is what they are going to receive. So obviously, I can say that company A would want the interest rates to go up so that they would receive more, and company B would want the interest rates to go down so they have to pay less. Okay. As there is a name given to such a party which is paying fixed, it is known as the fixed rate payer. Company A is the fixed rate payer. You can also say floating rate receiver. Okay, so guys, you can say company A as fixed rate payer. You can say it as floating rate receiver. And obviously company A would want interest rates to go up. whereas company B is opposite. Company B is the floating rate payer and fixed rate receiver. So such a party would want the interest rates to go down. Just see, guys, is everyone comfortable in this?
Yes, sir.
Yes, sir.
All clear? Okay. Now, let me give you more details, okay? Today, when they are entering into the contract, the 90-day LIBOR rate is 5%. Today, when they are entering into the contract, the 90-day LIBOR rate is 5% annualized, okay? This is annualized. Now, okay, after 90 days, we checked, okay, after 90 days, we saw that the LIBOR rate became 4.5%. After 180 days, it was 5.1%. After 270 days, it was 5.6%. Today means trade initiation date. Okay. So I've given you 90-day LIBOR rate at various points of time. Now, what I want from your side, guys, can you tell me how many settlements will happen here?
4 settlements.
4 settlements will happen. Very good. When would the first settlement happen?
1st April.
90 days.
After 90 days? Okay, I'm not using the dates, guys. You can use the dates also. First settlement would happen after 90 days. When will second settlement happen?
Up to 180 days.
Yeah. Guys, if you want to use dates, we can go to dates, okay? Let me know whatever you are comfortable with. Is it clear like this or you want to use dates?
Sir, please use dates.
All right. No worries. So let's say on 1st Jan 2020, company A enters into a 1 year, this whatever. All right. Okay. So 90-day LIBOR on 1st Jan 2020 was this much. Okay. On 31st March, or let me 1st April 2020, 1st July 2020, and 1st Jan 2021. So 4 settlements would happen. First would happen on 1st April 2020. Second would happen on sorry. Okay, please check now, guys, if it is clear or not.
So you have not given the LIBOR rate of 1st Jan 2022.
Not needed.
Sir,
Check now, guys. Are you clear with this much? So
Sir, 1st October 2020.
1st October 2020. Thank you. Thank you. Guys, are we clear?
Yes, sir.
Okay.
Sir, last settlement would happen on the basis of which rate?
Yeah, I am coming to that. Okay. Now let's do one thing, guys. What exchange would happen on first settlement date, that is 1st April 2020? Guys, can you try this question? What exchange would happen on 1st April 2020?
Sir, A will suffer a loss of $500.
Okay, see, guys, there is a little detail here. What is it? Whatever settlement is going to happen, yeah, I'm talking about interest rate swap specifically, okay? So don't generalize it. In interest rate swaps, what will happen is whatever settlement is going to happen on the settlement date, the amount of it would be known at a previous settlement date. Okay. What I mean is, when you are entering into the contract, at that time itself, you would get to know what is the exchange of funds that need to happen on first April. Okay. When are you entering into the contract?
1st Jan.
1st Jan. So on 1st Jan itself, you would be knowing, both the parties would be knowing what settlement needs to happen on 1st April. Okay. On 1st April, they would be knowing what settlement needs to happen on 1st July. On 1st July, they'll be knowing what is the exchange of funds that need to happen on 1st October. And on 1st October, they will be knowing what exchange of funds needs to happen on 1st January 2020. Okay. Now, guys, we are talking about 1st April. What exchange of funds need to happen on 1st April would be known on 1st January. Okay. What is the LIBOR rate on 1st January 2020?
5%.
5%. So this would be 5% plus 1%, 6%, right?
Yes, sir.
Party is making 6% and receiving 6% also. So does any exchange of funds need to happen?
No, sir.
No, sir.
Mhm.
So what exchange of funds would happen on 1st April? None.
None.
It's not that it would always be none. It's just that in this case, it is coming out to be none. Okay. Key point to note here is, guys, let's say this rate would not have been 5%. This rate was 5.1%. Then the exchange would happen, right? Because
Yes, sir.
company A would receive 5.1 plus 1, so 6.1, whereas company A needs to pay 6%. So 0.1% of funds would be given to company A by company B. But right now it is 5%. So it's like 6% they need to pay, and 5 plus 1, again 6% they need to receive. So we are saying no exchange needs to happen. Okay. Now, guys, can you tell me what exchange would happen on 1st July 2020?
ABC will pay 500 to XYZ.
Okay. Everybody, please try to get this answer, guys.
Yes, sir.
Okay, see, guys, whatever exchange of funds need to happen on 1st July would be based on 1st April LIBOR rate. Okay, what was the LIBOR rate on 1st April? 4.5%. Okay, so that means company A would pay 6% and receive 4.5 plus 1, that is 5.5%. So net off, they need to pay 0.5% extra, right? So company A would pay 0.5% of $100,000. How much is it coming, guys?
$80,000.
500?
500.
to company B. See guys, this is what is going to happen on first. Is it starting to make sense, guys?
Yes, sir.
Yes, sir.
Now you try for 1st October. What would happen on 1st October?
Company B will pay $100 to company A.
Whatever is going to happen on 1st October would be dependent upon the LIBOR rate of what time?
1st July 20.
1st July.
Yeah. So what was the LIBOR rate on 1st July? 5.1%. Okay. So company A would receive 6.1% and needs to pay 6%. So 0.1 extra they will receive. See, when the interest rates are going up, who is getting the benefit?
Company
Company A.
Okay. So company A would receive now, would receive 0.1% of this, that is $100 from company B. Okay. So guys, whenever the interest rates will go up, it would be beneficial for company A and vice versa. Okay, quickly tell me about the last one also. 1st Jan, what would happen?
Sir, company A will receive $600.
Again, interest rates went up, right? So that's good for company A. They will receive 6.6% and needs to pay 6% only. So net off, they will receive 0.6% extra. That is $600 from company B. Just check again, guys. If you want to calculate again on your end, you can do it. But let's be clear on this.
Sir, does both the company have to keep some kind of margin requirement when entering the contracts?
No, there is no margin requirement. Okay. There is no exchange of funds at the time of entering into the contract. But later on, we'll study that they need to put the collateral.
Okay, sir.
Okay, guys. I hope it's clear to everyone.
Yes.
Now, can you tell me who would use a swap? Who do you think, guys, would be participating in this swap contracts market? Guys, you know how banks work, right? I'm talking about a simple commercial or a retail bank. What do? They give out loans and they take deposits, right? So let's consider a bank. Let's say there is a retail bank and it is taking deposits from customers. And what it will do, it will lend out those funds to lenders, right? Or sorry, borrowers. So that's pretty much the business model of a retail bank, right? Now let's assume, guys, let's assume they are taking the deposits and paying fixed rate on deposits. Okay, so let's say they are paying, let's say, 3% on saving bank deposits to their customers. Okay, retail bank is paying this to their customers. Now, but on the loans, they are using a floating rate, so they are receiving floating rates. So their loan rates will keep on changing based on the rates in the market. Okay, so let's assume this scenario. They are paying 3% fixed on the deposits they are receiving from customers, but they are receiving a floating interest rates payment from their borrowers. Okay, now can you tell me, guys, can such a retail bank use a swap contract? Okay, before that, let me ask you this. Is the retail bank facing any risk? Is the retail bank facing any risk? Make a guess, guys.
Yes, sir.
What is the risk?
The interest they are receiving, that is the floating rate, might go down.
Absolutely, very good. Okay, the retail bank is facing the risk that the interest rates may go down. Okay, if the interest rates go down, what would happen? Their payments they are receiving would reduce. Yeah, this would reduce. Whatever money is coming in for them would reduce, but they still need to pay 3%. So obviously they don't want this to go down, right? So that's the risk they are facing, that interest rates may go down. Can such a retail bank use a swap contract to hedge against this risk?
Yes, sir, they go for a swap.
Sorry?
Sir, they go for a swap.
They can go for a swap. They can use a swap contract. Very good. Which position they will take in the swap contract?
Sir, floating rate will be higher. It's going to higher for retail bank.
Sir, they will take the fixed rate pair position.
Yeah, I'm asking between these two positions, okay? Will they be fixed rate pair or will they be floating rate pair?
Fixed rate pair.
Floating rate pair.
Sir, floating.
They will take the side of floating rate pair. Okay. They will take a contract, they will enter into a swap contract in which they will pay floating rate and receive fixed. So they will pay based on floating rate and receive based on fixed. Obviously interest rate we are talking about. Now, do they need to worry about interest rates? See, let's suppose interest rates go down. Let's suppose the interest rates go down. They will lose some here. They will lose some money here. I mean, they will receive less amount of money.
Yes.
No. Let's suppose interest rates go down. So this flow of cash flow stream would go down. But what would happen here? Would they be net earners or gainers or losers?
Losers.
They will be gainers here. If the floating rates go down, they need to pay less and receive more, right? If the interest rates go down, they'll be losing here. Yeah. But they will be gaining here.
Yes, sir.
Yes, sir.
So that loss would get compensated. So they don't need to worry about interest rates going down now. Even if they go down, they will gain here.
So they hedge their risk.
They have hedged against this risk they were facing. Now they are not facing that risk. Okay, so banks would be big participants in this interest rate swaps. Is it making sense to everyone?
Yes.
Yes,
Who
sir.
are the counterparties in such swap?
Banks would be dealing between themselves. Companies would be dealing. See, a company has taken a loan, right, for their growth. Now they are worried that the interest rates may go up. Here, the bank was worried that the interest rates may go down. Some bank might be facing a structure where they are receiving fixed and paying floating. So they will take a counter position. Okay.
Sir,
Yeah.
sir, in India, so what are the swaps transaction in one day? Is it higher than currencies other than commodity?
No. It's very, very less. Okay. In India, we don't have that depth. Okay. It's
But
all.
in US, it is so higher. I read it somewhere.
Yeah. In US, it is much higher. So see, these are OTC contracts, right? These are negotiated contracts between the two parties. So there is not that much amount of clarity in terms of the number of trades that are happening, at what value they are happening, right? It's not exchange traded where everything is very transparent, right? Okay. Let's try one more thing, guys. You tell me this. Okay, this is very simple. There is a client who has taken a loan from HSBC. Okay, you can consider it any company, let's say, okay, which has taken a loan from HSBC at a floating rate. What risk is the client facing?
The rate may go up.
What is the risk?
Rate might go up.
Yes, the client is facing the risk that the interest rates might go up. Okay. How can they hedge their risk using a swap contract?
There will be a floating rate pair and a fixed rate.
Which position in?
Fixed rate pair.
Yeah. So they will take a floating rate receiver. They will take floating rate receiver position, or you can say fixed rate pair position in plain vanilla interest rates. Okay. So what would you call the client? Is the client speculator, hedger, or arbitrager?
Hedger.
Absolutely. Okay, good. Client is hedging against the risk he's facing. So he's acting as a hedger in the financial market. Okay. Let's say there is a company A which expects rates to go down, and there is a company B which expects rates to go up. Okay. They are not facing any risk currently. They are not facing any risks. They don't have any exposure currently. Okay. Can they enter into the forward? Can they enter into a swap contract to play on the basis of their expectations?
Yes, sir.
They can go for a speculation.
Yeah. So if they enter into a swap contract, they will be known as speculators. They are not hedging against any risk. They are not even facing any risk, but they are taking the exposure now to make profit. So they'll be known as speculators. Okay. Which position company A will take?
Floating rate.
Receiving fixed rate.
Floating rate.
Yeah. Am I right? Guys, are we clear?
Yes, sir.
Okay. I'm giving you a swap contract. Please understand this. Okay, guys, my first question is, which side would company A and company B take?
The company A pay fixed rate and receive floating rate.
Company A would, everybody guys, please everyone participate.
Fixed rate payer.
A fixed.
A fixed, good. And vice versa for company. Okay. My next question is this.
For the first year, there will be no gain or loss.
So net gain or loss for the 3 years will be 3 lakhs.
Let's suppose the trade initiation date is 1st Jan 2021. Okay. Now you tell me, first of all, which will be the settlement dates? How many settlements would be there?
3.
3.
What would be the settlement?
1st Jan 2022. 1st Jan 2023 and 1st Jan 2024.
Very good. Okay. So what settlement would happen on 1st Jan 2022?
And no settlement.
When it would be decided what needs to happen on first settlement day?
1st Jan 2021.
1st Jan 2021.
Right. What was the LIBOR on trade date?
5%.
5%.
What is the floating rate? LIBOR only.
5%.
5.
Straight is float. So see guys, diagrammatically, if we see, there is company A, which is always going to pay 5%, and there is company B, which is going to pay LIBOR. So it's as simple as that. I hope it sounds simple now. Right. So what was the LIBOR on trade date? 5%. So 5% and receiving doesn't make any sense, right? So there'll be so again, guys, here we have a case where there is no exchange of funds needed. Good. What about 1st Jan 2023?
Sir, 1 lakh rupees.
$1
Company A needs to pay 5% and company B needs to pay what? 6%?
6%.
LIBOR is 6%. So, all right. So company A would receive 1% of 10 million.
10 million. 1 lakh.
Company A would receive how much, guys? 1% of 10 million. Okay, so basically $100,000. Yeah. And what would happen on 2024? The rates are going up. So it's going to benefit again company A. Company A would receive
$2 lakh.
$2 lakh from you.
$2 lakh.
Note it down, guys. If you have any doubt, let me know. Guys, are we clear? Can we go ahead? Yes or no? Everybody awake?
Yes,
Can we
sir.
have a break?
Yes, sir.
Okay. So I hope we are clear on plain vanilla interest rate swaps, right?
Yes.
Talk about
Yes, sir.
very simple. Just it will take 2 minutes and then we'll take a break, guys. Okay. What happens in basis swaps? There'll be floating versus floating. So what will happen? There is a company A which will be making payments based on LIBOR, let's say, and receiving payments based on, what do you think?
My bad.
For us, yeah, rather than any protein.
Euribor, let's say, okay, MIBOR, let's say, anything,
Sir, I
okay?
wanted to ask something.
Yeah,
Sir,
tell.
sir, in the last example, isn't the floating rate LIBOR plus 1%? But you have only
No,
considered
no, the
margin.
floating rate was simply LIBOR,
Okay, okay.
okay? There was no extra.
So isn't it necessary to be plus 1%?
No. These are completely negotiated contracts between the parties.
Okay.
They might have just the LIBOR, they might have LIBOR minus 1%, they might have LIBOR plus 2%, they might have MIBOR, they might have Euribor, they might have any other rate, okay? Okay, so this would be basis swap, guys. When would company A enter into such a swap? When they expect Euribor to go up and LIBOR to go down. And company B would enter into such a contract when they expect the opposite. They expect Euribor to go down and LIBOR to go up. Okay, so guys, only difference here is everything else will remain same. You can use it for speculation or hedging depending upon the needs of two parties, but here you don't have any fixed rate. So everything would keep on changing, and whichever party expected the right thing would be able to make gains, and whosoever's prediction doesn't come out to be true, that party would lose. All right, so that's about interest rate swaps, guys. Let's take a break here and then we'll start with equity swap contracts. Okay, see you after the break, guys. Okay, guys, let's continue. Everyone, please come back. Guys, is everyone back?
Yes, sir.
Yes,
Yes,
sir.
sir.
Yes, sir.
Yes, sir.
Yes.
All right. So next we have the equity swap contracts. Very similar. Only thing is underlying asset will be equity. Okay. So guys, what happens here is there'll be two parties. Again, let's say company A and company B. So now exchange of payments would happen based on the stock performance or index performance by one party.
Sir,
Yeah.
sir, sorry to disturb you, but I have one question. In
Yeah.
general, sir,
Yeah.
what is your thoughts about on the LIC? Have you saving would no give not to them or not?
Sorry, which one? LIC?
LIC IPO.
LIC IPO. I am not in big favor of that, okay, because it is a government run entity and the history of government running the businesses has not been great.
Because in
If
the
we see
news say
where,
that
if we see
investment
everything
is
there.
happen.
Yeah, I mean, if they are losing control and it would become a private entity, then it's fine. But still, there is a lot of backlog in terms of what the government has done so far. So it will not really be easy to clear that mess, right? It in detail, guys, but I'm not a big fan of government running businesses. If you see the examples such as Air India, MTNL, wherever the government is running the businesses, it's not able to compete with other private players. So same is with LIC. If you look at other players, let's say HDFC Life, ICICI Pru, SBI Life, they are still doing better than LIC. Okay. Anyways, so let's go ahead with this. So one party would be making the payments based on equity. Okay, it can be a particular stock or it can be a Sensex, Nifty or Bank Nifty, right? Whereas on the other hand, the party would be receiving the payments based on the performance of equity or stock. Okay, it can be equity, it can be index, it can be interest rates also. So guys, this would be how the structure would look like for swap contracts. On one side, you have a equity leg, right? What do we call, guys? We call, there is one leg would be definitely the equity leg, okay, where the cash flows are happening based on the performance of stock or index, and the other leg would be it can be an equity leg or interest rate. Interest rate can again be fixed or floating, or it can be an equity or index-based cash performance. So guys, one party would be making the payments based on the performance of a stock or index, and receiving the payments based on the performance of another stock or another index, or interest rates, which can be fixed or floating. That's the broad structure of a equity swap contract. Guys, can be an interest rate leg, or you can also call it floating leg if it is based on floating interest rates. You can also call it floating leg. Okay. So what would happen is, let's say company, I'm just giving you some examples. Okay. Company A is going to make payments on based on Microsoft shares. Okay. And going to receive payments based on, let's say, NASDAQ index. Okay. So this could be one structure. The other structure could be the company A is making the performance based on Sensex index, okay, and receiving the payments based on LIBOR. Okay. The third structure can be company A is making the payments based on Sensex index and receiving the payments based on let's say NASDAQ index. Okay. Another structure can be company A is making the payments based on Apple shares and receiving the payments based on 5% of notional amount. So all these are examples of equity swap contracts. Just see, guys, are we clear with this? One leg would definitely be equity leg, whereas the other leg can be anything. Guys, are we clear so far? Yes or no?
Yes, sir.
Pakka, everyone?
Sir, why would someone enter into an equity swap contract? I mean, if somebody wants to make a gain or a loss from an equity, so they can directly do that from the stock market.
Yeah. See, again, you are not actually buying or selling the shares. Okay, let's suppose you are bullish on Microsoft shares. You don't want to buy. I mean, you don't want to put in that much cash. You don't want to block that much cash. So rather you can enter into a swap contract.
Okay.
Okay. Okay. So why would anybody enter into this contract? Can anybody tell me? Why would company A enter into this contract?
If they believe that the price of Microsoft share will increase.
They expect NASDAQ to do well, but Microsoft to perform badly. Okay. Why would company A enter into this contract? They expect LIBOR to go up, but Sensex to perform badly. Okay. Why would company enter into this contract? They expect NASDAQ to do well, but Sensex to perform badly. Are we getting some hint, guys?
Yes, sir.
Why would company enter into this contract? They expect Apple shares to rise by less than 5%. They expect Apple shares to fall or rise by less than 5%. Why would company A enter into this contract? They expect Apple shares to fall or rise less than LIBOR plus. And similarly, there will be other party, company B, which is having the opposite. Just see this, guys. If you have any doubt, let me know.
Can we note it down?
Sure, please do. Guys, noted? Can we go ahead? Guys, is it noted? Can we go ahead?
Yes, sir.
Yes, sir.
All right. So let me give you an example to help us understand it better. Okay. Please look at this. Guys, are we clear on the question?
Yes, sir.
So what is happening here? What would company A be doing?
It's a 3% fixed rate on
Based on which, based on what?
NASDAQ 100 index.
Based on the performance of NASDAQ 100? Are we clear with this? Company A would receive 3% fixed rate. So they are going to receive 3% fixed rate from company B. Yeah. And would pay, company A would pay semi-annual return of NASDAQ. Are we clear with this, guys?
Yes, sir.
Yes, sir.
What is the notional amount?
$100 million.
100 million, okay. All right. So that's the NASDAQ level. NASDAQ level on 1st Jan 2020 is given as 4150. Okay. Now, what will be the settlement dates? Quickly, guys. What settlement dates?
1st July
1st July
2020.
2020.
And
1st Jan 2021.
Sir, 1st July 2019. Yes, sir.
is this correct? Okay. So guys, I am giving you NASDAQ level on these dates. Then we'll do the calculation. Okay. So on 1st July 2020, the NASDAQ level is, let's say, 4233. Okay. Now it comes down to 4085. Then it becomes 4510. Then it becomes 4300. Okay. So this is the NASDAQ level at different dates. Okay. So can you tell me what settlement would happen on 1st July 2020? Guys, if I ask you, what is the expectation of company A? Why would company A enter into this contract? What are they expecting? Can you tell me that?
NASDAQ index
That
go down.
NASDAQ index goes down.
What is the expectation of company A?
NASDAQ to perform bad.
Okay. So NASDAQ to or rise
Of interest.
I mean, fall as much as it can. Yeah. Even if it is rising, it should rise less than 3%. Okay. Is everyone clear with this point, guys?
Yes, sir.
Yes, sir. Yes, sir.
Okay. Okay. So tell me what would happen on settlement date. If I ask you guys from 1st Jan to 1st July during this semi-annual period, how did the Nasdaq perform? What was the Nasdaq performance in this semi-annual period?
Good. Let's go by some points.
2% increased.
Okay, Nasdaq was 4150 6 months back. Now it is 4233. So it increased by 2%, right? Can I say plus 2% during the last 6 months? Yes or no?
Yeah, yes, sir.
How did the Nasdaq perform between these 6 months, July to Jan? Can I say minus 3.5%, guys? You know how to calculate this one, right?
Yes, sir.
Everybody calculate and let me know what are you getting? Are we clear? How did the Nasdaq perform during this period?
Increased by 10.4.
Decreased by 4.65%.
Let's keep it 2 decimal places, okay? Just for consistency sake, let's keep it 2 decimal places. Okay. Is everyone clear with these calculations?
Yes, sir.
Yes. All right. So tell me, let's look at 1st July. Okay. Tell me what would happen, guys. Now it's very simple. How much company A needs to pay Nasdaq, right? How did NASDAQ do? Plus 2%. So company A needs to pay 2%.
Yes, sir.
And would receive 1%, would receive 3%. So net off, they will receive 1%. So company A would receive 1% of notional amount, that is 100 million. So they will receive how much? $1 million from. Is it clear?
Yes, sir.
What would happen on 1st Jan 2021?
Company A would pay 0.50 of $100 million.
Okay.
So it will receive 6.5 million.
Guys, this is tricky. Okay. See,
It will receive 6.5% from
yeah,
company B.
that's correct. That's correct. Okay. See, guys, what is happening here is company A needs to pay based on the performance of NASDAQ, right? If NASDAQ goes up by 1%, they need to pay 1%. If NASDAQ goes up by 10%, they need to pay 10%. But what if NASDAQ goes down? Then they would receive payment, okay? So they would receive this 3.5% along with the 3%. So company A would receive how much?
6.5%.
Absolutely. Okay. Okay, what about 1st July 2021? What would happen here? Then company A needs to pay how much?
Yes.
0.40.
10.7.
Company A needs to pay 10.4% and they will receive 3%. So here, net off
7.4%.
absolutely. Company A would pay now 7.4% of this, that is approximately $7.4 million to company B. Okay, and what about the last settlement date?
Company A would receive 8.05% of the national amount.
8.65
National amount.
is, that means 8.65 million from.
Sir, it will be 7.65.
Sorry. Thank you.
Yes.
Guys, are we clear? Can we go ahead?
Yes, sir.
Sir, can you please explain the settlement amount of 1st July?
This one?
1st July 2020.
This one? 2020?
Yes, this one.
So basically, see, on every settlement date, company A would pay based on the performance of NASDAQ 100 in the last 6 months. Yeah. How has the NASDAQ performed in last 6 months? 2%. Yeah.
Yes, sir.
A needs to pay 2% of this. There'll be a notional amount just for the calculation sake. So 2% of this, right? Company A needs to pay. And company A would receive 3%. So net off, they will receive 1%. Not clear?
No, sir.
Okay, guys, anybody would like to try to explain this? How have we done this calculation, guys? Anybody who is clear, please help me out here. Okay, guys, nobody is clear. Okay, see, what is happening is company A needs to pay on the basis of performance of this index. Okay, it's an index of 100 stocks of USA. Okay, so you have Sensex, you have Nifty, right? Like in India, it's a collection of 50 stocks, 30 stocks. Similarly, NASDAQ 100 is an index, which is a collection of 100 stocks. So every day trading is going on, the stocks are going up or down. Similarly, the level of an index, NASDAQ index will keep on changing, right? So the two parties.
Actually, sir, my question is,
Tell me.
actually that if Nasdaq level is going up, then how would company would receive 1%? Company A wants to perform Nasdaq bad, right?
They expect
Nasdaq level
NASDAQ
is
to
going up.
perform badly. Matlab, they expect NASDAQ to either fall or rise less than 3%. Okay. So what is happening? In this case, NASDAQ, did it meet their expectations? What the company A was expecting, did it happen?
Yes, sir.
It happened, right? So their expectation came out to be true. So they will make profits. Just give me a minute. Okay. Anushka, you have the query? You have the doubt?
No, sir.
No, sir.
Nasreen, okay. See, Nasreen, the company A doesn't expect NASDAQ to go up. But if it goes up, they have to pay. Okay. For example, here it went up by 2%. They have to pay 2%. goes
Yes,
up by
sir.
5%, they have to pay 5%. They don't want Nasdaq to go up. They want stock market to perform badly, or they expect that. Whereas company B expects stock market to perform very well. Okay, Nasdaq to go up by more than 3%. They have opposite views. Okay, so if it goes up by 2%, company A needs to pay 2%. And they will receive 3% always. So net off, they will receive 1%.
Okay, sir. Okay.
Sir, I have a question.
Yeah.
Sir, you told in swaps, we know beforehand that what we have to pay, but in this case, it's not like that.
See, I told you, don't generalize it. Buddy, you listen to half of what I said. Okay, that was for interest rate swaps. Okay.
So it's not applicable in this one.
Yeah, not applicable.
Okay.
All right. So let me know, guys. Still go through this again if you want to. If you have any doubt, let me know. I'll not go ahead until and unless you are clear on this. Are we all clear, or do you want me to give some more examples of equity swaps? Yes or no?
Yes, sir.
Yes, that's it.
Okay. So let me check whether you are clear or not. There are two companies. So let's replace it by company A. See, guys, it can be a company, it can be a bank, it can be anybody. Okay. Right now we are understanding the instrument. Okay. So tell me, can these two parties enter into any equity swap or not?
Yes, sir. They can enter.
Yes, sir.
They can enter?
Yes, sir.
Which position will company A take?
Fixed stop.
Interest rate
Will
to
pay on the basis of what?
stock market go down.
They would like to pay on the basis of index performance. Are we clear?
Yes, sir.
And company B would pay on basis of what?
Interest rate.
Interest
Yes,
rate.
interest rate.
Okay, so that would be the equity swap. Okay. Let me ask you one more question. Tell me about this one.
No, sir, they cannot enter in a contract.
What would happen? Company A would pay on the basis of what?
Tesla
Yeah.
shares.
Tesla.
Absolutely correct. Whereas they would receive on the basis of?
Tesla only because company B also expects this.
Apple shares.
Apple share.
Performance.
Sir.
But in the question, it's written that both expect the same thing only.
Sorry, please read it like this, okay? Is it clear, guys? Can I ask you a further question on this? If it is
Yes, sir.
okay. Okay, tell me what settlement happen on okay. Guys, if you have any doubt in question, let me know. Otherwise, please try to solve. Guys, I hope you are calculating, right?
Yes, sir.
If you have any doubt in the question, let me know, okay? Okay, so what is going to happen on 1st Jan, guys? Can you tell me 2021?
So company A will receive $70 from company B.
Okay, how did Apple shares perform? Can I say plus 80%?
Yes, they
Yes,
increased
sir.
by 80%.
Yeah. How did Tesla perform?
5%.
5% increase.
Very good. Here, how did Apple perform?
5.5%. 5%.
Okay. What about Tesla?
Minus 5%.
Minus 4.76%. Okay, guys, I hope you are clear with the calculations. How are we calculating this? 180 minus 100 upon 100, okay? Correct? Now it's very simple. Guys, let me know when you are done with the calculation part so that we can go ahead. Okay, now what does company A needs to pay on 1st Jan 2021? Company A needs to pay based on Tesla shares. So how did Tesla perform? 5%. So
5%.
5%, yeah. And they would receive 80%. So in net, company A would receive 75%, right?
Yes, sir.
Big gain for them, okay? without putting any money on the line, they have made $75 million from company B. Okay. Do they have to buy any shares? Do they have to sell any shares? No. They just make money. Okay. And what about company? What about 1st Jan 2022? Company A would pay on the basis of Tesla. Tesla gave, that's awesome for them, right? So company A would receive in this case, how much?
10.26%.
10.26% is absolutely correct. Basically, you add these two percentages and you get your amount. 10.31 if I am right. Just check guys. Huh? Are we right here?
Yes, sir.
All right. Guys, I'll take your attendance now. Meanwhile, you can just check, guys, are you completely comfortable with equity swaps and interest rate swaps? Any question you can ask me now, you can ask me next class also, anytime, okay? Ashutosh?
Present, sir.
Mansi would not be here, I believe. Okay. And Moksh?
Present, sir.
Parichay?
Present, sir.
Yogita?
Present, sir.
Anushka?
Present, sir.
Paridhi?
Present, sir.
Diksha? Diksha? Diksha, I can see you in the list. Are you there? Okay. I think your mic is not working maybe. You have put it on the chat box. I'll mark you present. All right. Rudraksh?
Present, sir.
Azwal?
Present, sir.
Nasreen?
Present, sir.
Zeenat?
Present, sir.
Rabeen?
Present, sir.
All right. Great, guys. Just checking on the feedback, guys. Are we clear on what has been discussed so far? I mean, my pace and my way of explaining, are you able to get it?
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
All right, guys. If you face any problem, let me know, okay? All right. Thank you so much, guys. I'll see you in the next class. Bye-bye.
Thank
Thank
you,
you,
sir.
sir.
Thank you, sir.